Good afternoon, and welcome to the Reverse Inquiries Workshop Series session on NAIC investment-related developments. I'm Larry Hamilton, partner in the Insurance Regulatory Group at Mayer Brown, and joining me is my colleague Jared Wilner, also a partner in that same group. And we have an hour for our workshop today, so I'm going to plunge right in. Next slide, please. We're talking today about some key NAIC initiatives affecting insurance company investments. And what we're going to talk about, there's so much we could, but we focused on what we think are some of the major issues that people should know about. Number one, there is a new principles-based definition of what constitutes a bond that gets reported on Schedule D, and that will become effective in just a few weeks on January 1st, 2025. A second topic is that risk-based capital, or we say RBC, charges on residual tranches of asset-backed securities are increasing this year for the 2024 calculation from 30% to 45% for life insurance companies and 15%, 20% for health and P&C insurers. And the third is that a new process has been adopted, won't be effective until January 1st, 2026, but it will allow the NAIC staff to challenge and potentially override the designations on fixed income securities that are derived from rating agency ratings. Finally, we'll say a little bit at the end about a methodology for modeling of CLO investment designations that is still under development. Next slide, please. Little background first. Some of you may know a lot about this. Some of you may be new to it. So I just wanted to level set for everyone about who does what at the NAIC. Next slide, please. NAIC exists because in the United States, the business of insurance is regulated primarily at the state level. So the NAIC, which stands for National Association of Insurance Commissioners, is a body that sets standards and supports the regulators, and it's governed by the regulators of the states. Within the NAIC, there is a committee called the Financial Condition Committee, often called the E Committee, because every of the top tier committee of the NAIC has a letter associated with it. It coordinates financial aspects of the standard setting at the NAIC and has many subgroups, 37 the last I counted. 3 of them are quite important for us today. Next slide, please. Here's a little family tree, a modified, abbreviated family tree showing under the Financial Condition Committee the different groups that are of relevance to us. The ones in gold, the Statutory Accounting Principles Working Group, the Risk-Based Capital Investment Risk and Evaluation Working Group, and the Valuation of Securities Task Force. And reporting to that task force are 2 groups of NAIC staff, the SVO, Securities Valuation Office, and the Structured Securities Group, or SSG. Next slide, please. I'm going through this part fast because I think you probably all want to get to the meat of things. The Statutory Accounting Principles Working Group is responsible for, as its name implies, developing and maintaining the principles that govern financial reporting by insurance companies. They use something called statutory accounting rather than GAAP. Valuation of Securities Task Force does not do what its name implies because it doesn't value securities, but it actually assesses the investment risk associated with securities that insurance companies invest in. And as I mentioned, it oversees the SVO and the SSG. Next slide, please. The RBC Investment Risk and Evaluation Group is the youngest of those bodies. It was only launched not quite 3 years ago. It reports to the Capital Adequacy Task Force, and it has a mandate to review the investment risk component of the RBC framework and is focused on the RBC treatment of asset-backed securities, including collateralized loan obligations, collateralized fund obligations, and other securities with similar types of tail risk. Has both long-term and shorter-term objectives. Next slide, please. Why do insurers want investments to be bonds and to be filing exempt? Some of you, if you're with an insurance company, you know all about this. If you're someone that structures investments for insurance companies, you might be wondering, what is this I hear about? Will it be on Schedule D? Will it be a bond? Will it fit the new definition? What new definition? That's what we're about to talk about. So next slide, please. Bonds is the term that the NAIC uses for fixed income investments other than preferred stock. And historically, if it was in the form of a debt instrument, it was a bond. Bonds go on Schedule D, as in Delta, of an insurance company's statutory financial statements. And the RBC charge for a bond is based on the NAIC designation category that is assigned to it, with 1A being the highest and 6 being the lowest. Bonds, as long as they're above NAIC 6, are carried at amortized cost on the statutory balance sheet. Only if they go down to NAI 6 would they be carried at the lower of cost or fair value. So next slide, please. Not going to dwell on this, but it gives you an idea of how the RBC factor is sensitive to that NAIC designation. And it shows the rating agency equivalent for each of those designations. You see a range from a 1A, which is the highest, with an RBC factor of 15.8 basis points, ranging in increasing levels all the way up to 30% for an NAIC 6, which would be equivalent for a life insurance company to the RBC charge for a common equity investment. Next slide, please. How do bonds get their NAIC designations? Well, it's been estimated that over 80% of the time, they are what's called filing exempt, which means they automatically receive the NAIC designation that's equivalent to their credit rating from an NAIC recognized credit rating provider. Credit rating provider list is currently the same as the SEC's list of nationally recognized securities rating organizations. If the bond isn't filing exempt, then it gets filed with the SVO, and the SVO conducts a risk assessment, and they assign an NAIC designation to the bond. So since the great financial crisis, the staff at the SVO and SSG have felt that the rating agency assessments of credit risk of certain types of investments may not be reflecting the full range of investment risks that regulators care about. And so they have overall, over time, been seeking to reduce the NAIC's reliance on the rating agencies, although there still is significant reliance through the filing exempt process. Next slide, please. So to summarize all this introductory material, the two big things insurance companies care about: they want their fixed income investments to be treated as bonds, meaning that they're reported on Schedule D, they get an RBC factor based on their NAIC designation, preferably a lower one. NAIC 1 and NAIC 2 are the investment grade designations. And also being on Schedule D and being above NAIC 6 means carrying the bond at amortized cost without introducing a market element. That's statutory accounting. That's governed by the Statutory Accounting Principles Working Group, which we often call by its acronym of SAPWIC. The insurers also want their fixed income investments to be filing exempt so that they automatically receive the NAIC designation based on that CRP rating, rather than having to be filed with and analyzed by the SVO. That's governed by the Valuation of Securities Task Force, sometimes called BOSS Task Force. Next slide, please. So now I'm going to introduce a little bit about this new definition of what is a bond. It's a principles-based definition, and then Jared will also continue explaining that. Next slide, please. The new principles-based bond definition, it's in Statement of Statutory Accounting Principles, number 26 and 43, primarily in 26. A bond is, number one, a security. If it's not a security, it's generally not going to be a bond, although there is a special provision that bank loans are scoped in to bond treatment. We won't be talking about that today. Bond is a security. Second, it represents a creditor relationship. And third, there's a schedule for one or more future payments. And now we bifurcate. It has to be either one of two things: an issuer credit obligation, which we might call an ICO, or an asset-backed security. And the definition of asset-backed security here is not the same as the one that the SEC uses in Regulation AB. Is broader. And Jared's going to dive into that in a few minutes. Very importantly, there is no grandfathering of existing investments. All portfolio investments that an insurance company owns to be treated as bonds are going to have to satisfy this new principles-based bond definition effective on January 1st, 2025. Next slide, please. The definition, what is a security? In this case, statutory accounting copies the definition of security from GAAP. and I won't spend time on this. It's in the slides. You can look at it, but this definition from SAP 26 is taken right from the applicable GAAP guidance. Next slide, please. Issuer credit obligations. Remember, that's one of the two flavors of bonds under the principle-based definition. It has to be either an issuer credit obligation or an asset-backed security. So issuer credit obligation, ICO, is a bond where the repayment is supported primarily by the general creditworthiness of an operating entity or entities. You're not looking at isolated pledged collateral to provide cash flows. That's going to be in the asset-backed security category that Jared will talk about. Here you're looking to the general creditworthiness of an operating company. And so the ICO is issued by an operating company, or in many cases issued by the holding company that owns the operating company and accesses the cash flow from upstream dividends. Examples of ICOs: treasury securities or government agency securities, muni bonds, corporate bonds, project finance bonds, bonds issued by REITs, bonds issued by funds that are operating entities. We'll talk more about that later as to whether a fund is or is not an operating entity. The original draft of the definition allowed bonds issued by 40 Act registered investment companies to be issuer credit obligations, but not unregistered funds. The final definition allows debt instruments issued by unregistered funds to be issuer credit obligations if the funds are operating entities. Convertible bonds, and then I left the best for last. We'll talk about that some more. Securities where the repayment is fully supported by an underlying contractual obligation of a single operating entity. So next slide, we're going to talk about that. It's a paragraph in the definition and examples that are given of when a security has repayment that's fully supported by an underlying contractual obligation of a single operating entity. Examples are credit tenant loans, equipment trust certificates, other types of lease-backed securities, and funding agreement-backed notes. That's kind of a miscellany of different types of securities, but what they have in common is that definition that the repayment is based on an underlying contractual obligation from a single operating entity. And fully supported is defined to mean that all the interest and at least 95% of the principal are going to come from the contractual cash flows. And sometimes the issuer can be a special purpose entity. Generally speaking, an issuer of an ICO has to be an operating entity or a holding company of an operating entity. But when you're looking at this subcategory, you actually could have the bond issued by an SPV that has the right to the underlying contractual obligation that generates the cash flows. Next slide, please. Okay, I promised you I would say more about when a fund is an operating entity. And that the definition says that the primary purpose of the operating entity is raising equity capital and generating returns to equity investors. So the operating entity can incur debt, and it uses the term in the guidance ancillary debt. Ancillary debt to fund operations or for leverage to the equity holders, but this is in service to meeting the fund's primary objective, which is an equity investment. In contrast, an ABS issuer has a primary purpose of raising debt capital. And so there's generally a contractual waterfall of how the cash flows generated by the underlying collateral gets applied. There's very little discretion afforded to the manager or the servicer. There's this hard wiring allows for higher amounts of leverage to be issued than would be possible for a fund representing an operating entity. And that emphasizes that an ABS is raising debt capital, and an operating entity is more of a managed kind of fund that uses debt in an ancillary way. And for those that were wondering about this, feeder funds and issuers of collateralized fund obligations are expressly defined as ABS issuers. They do not get to be treated as operating entities for this purpose. Next slide, please. For the 40 Act registered fund, there's a practical safe harbor. If a 40 Act fund is issuing debt in accordance with the leverage ratios that the 40 Act permits, the 300% asset coverage ratio in the 40 Act, then that is treated as debt issued by an operating entity. So you don't need to do any further analysis if it's a registered fund. If the fund is not registered, it can still be an operating entity following the guidance on the last slide. It has to be determined to be an operating entity whose primary purpose is raising equity capital and generating returns to its equity investors. And at this point, let's turn it over to Jared. I've been talking about the issuer credit obligation side of the bond definition. He's going to talk about the asset-backed security side.
Thank you, Larry. Next slide, please. Oh, perfect. So an asset-backed security, in order to constitute a bond and therefore qualify for bond treatment, is a debt instrument issued by an entity for purposes of raising debt capital, and it satisfies two further conditions. First, its underlying assets are comprised of either financial assets or cash-generating non-financial assets. They're owned by the issuer of the security, the ABS issuer, and they constitute the primary source of repayment, and they throw off meaningful cash flows. The second condition is that the structure of the ABS issuer redistributes credit risk. What does that mean? In practice, it means that the holder of the asset-backed security needs to be in an economically different position than if they held the underlyings directly. There's an awful lot to unpack in that definition. There are nested definitions and a number of further kind of conditions and special rules. We'll work through all of that over the ensuing slides, but at this point, I want to offer a simple heuristic to help you decide whether you're dealing with something that is subject to the ABS definition and you have to deal with all of that complexity that I just alluded to, or if you get to work through the much simpler and I think more easily achievable ICO definition, and that is whether the security issuer is an SPV. If it is, you will almost always be dealing with an ABS. That's because the concept of an operating entity is baked into the definition of an ICO. I say almost always because, importantly, as Larry pointed out, you have Section 7G of the definition, which allows for certain instruments that are fully supported by a single obligor, by the contractual obligation of a single obligor, to constitute an ICO, and that single obligor can be an SPV. That's an important caveat. But as a heuristic, one way to deal with some of the complexity of these different definitions is just to ask yourself, what's the nature of the security issuer? If it's an SPV, unless you can find a way to shoehorn it into the ICO definition, you're going to have to deal with what we're going to discuss now. So next slide, please. The definition of financial assets. Maybe two key points here. We won't spend too much time on this. What is a financial asset versus what is a cash-generating non-financial asset? Importantly, financial assets don't depend in any way on the completion of a performance obligation to throw off cash. If you're in a world where something needs to be performed in order for a payment to arise, you're looking at a non-financial asset. I mentioned two key points, the other being that the NAIC has advised that when you're looking at an ABS structure, there can't be commingling of financial assets, and cash-generating non-financial assets in the structure. Next slide, please. Okay. Diving in just a little bit deeper into those two conditions. So as I had mentioned, assets owned by the ABS issuer must either be financial assets or cash-generating non-financial assets that throw off meaningful levels of cash flow. What is meaningful? Well, a couple things. One is it's determined as of the date of origination, and it's specific to the transaction. Other than that, there isn't a hard and fast definition that we can point to of what constitutes a meaningful level of cash flow because it is specific to the transaction. But the NAIC has articulated a safe harbor. So where an ABS issuer's payment obligation, 100% of the interest, and at least 50% of the principal, does not rely on the sale or refinancing of those underlying assets, then the cash flows generated by those underlying assets will be considered meaningful. The second condition has to do with credit enhancement. I had mentioned that a substantive credit enhancement should be thought of as conditions which put the holder of the ABS in a different economic position than if it had owned the underlyings directly. Well, examples of those conditions would include things like guarantees, subordination, and over-collateralization. Next slide, please. There are special rules if the underlyings are equity. So there's a rebuttable presumption that debt instruments collateralized by equity do not qualify as bonds because they don't reflect a creditor relationship in substance. But that presumption can be rebutted if it can be shown that the underlyings, the assets underlying the ABS structure themselves are likely to produce predictable cash flows, bond-like cash flows, and the equity risks are sufficiently redistributed through the capital structure of the issuer. It's important that for ABS, where the underlyings are equity, that there is an analysis that's documented at the time of investment as to why that presumption has been effectively rebutted. And you can look to sort of a number of factors when doing so. We've listed a few on the next page. Let's just move to slide 24 now, please. Without going through all of these in detail, but this is a non-exhaustive list of factors that you can consider when trying to overcome that rebuttable presumption. Just pausing for a moment on the very first one, the number and diversification of the underlying equity interests. If there are fewer and less diversified equity interests, you're going to have a harder time rebutting that presumption. In order to do so, you're going to need more detailed documentation explaining why you've done so. More and more highly diversified the equity interests are, the easier it will be potentially to overcome that presumption, also contingent upon other factors of the security, and possibly the less rigorous documentation you might need. Let's just pause here before moving on. I want to share a couple examples now. They're not in the slide deck, just to work through whether something's an ABS or not, because there's a lot, as I mentioned, there's a lot of nested definitions and sort of facts and circumstances to take into account. So we'll just work through three, I think, relatively simple examples. So the first is you have a security, it's collateralized by private debt funds, private equity funds. It has 300 million of fixed principal, but the interest component is mixed. It's 5% fixed, and 20% can depend on the equity return to that single private equity fund that's collateralizing the security. There is credit enhancement in this structure. So let's just assume for purposes of this discussion, there's the subordinated tranche absorbs 60% of loss. So it looks like there's credit enhancement. Is it a bond? Well, we know it's not an ICO. Can it work within the ABS definition? The answer is no, because there's a non-debt variable. Repayment depends on the performance of the underlying equity fund. Let's kind of toggle the facts just a bit and look at it from another angle. Assume the collateral here is now leased property. Well, a very kind of simple principal and interest structure. We have 100 million of fixed for principal and 4% fixed for interest. That leased property, payments arising from the lease cover 100% of the interest and 98% of principal. Is this an ICO or is it an ABS? This is actually going to fit within the ICO definition, and we're going to point back to and kind of underscore that section 7G, because here the payment obligations are fully supported by that single obligor, the contractual obligation of that single obligor. The kind of interesting factual point to take away from this example is the 100% of interest and repayment of 98% of principal. If it hadn't been 98%, if it had been less than 95%, then it wouldn't be quote unquote fully supported, and this would fail to satisfy the requirements of 7G. One last example, and then we'll keep moving on in the interest of time. Here, instead of a single lessee, let's assume there are 3 different lessees, same principal and interest structure, 100 million of fixed, principal 4% fixed interest rate. Cash flows cover 30% of interest and 10% of principal. This wouldn't be a bond under either the ICO prong or the ABS prong because we don't have meaningful cash flows. We're not in that safe harbor, so we don't have that. We're not meeting that 50% threshold. And otherwise, it's unlikely that 30% of interest and 10% of principal would constitute meaningful cash flows, notwithstanding any specific facts of the structure. Let's move to the next slide, please. Okay, given these changes, there are some securities which historically had received bond treatment, which will no longer do so. One such type of security is a structured note, and the other is a principal protected security. We'll say a little bit more about PPS later on in the deck. We can move to the next slide, please. So what happens if a debt security fails to meet the principles-based bond definition going forward? Well, if it has an SVO rating, then the RBC factor will flow from that SVO rating. And if it doesn't, on and after January 1st, it will need to become SVO. It'll be filed with the SVO and it'll have to receive its NAIC designation through that process. It will no longer be filing exempt. Next slide, please. So non-bond debt securities will no longer be filing exempt, which means they'll no longer be able to derive an NAIC designation from their private credit rating. This is kind of maybe just recapitulating what I just said. For life insurers, if it's been assigned an SVO rating, then that will flow through to the RBC factor. And if that's not the case, if it does not have an SVO rating, it will need to obtain one. The rules as they currently stand are slightly different for P&C and health insurers, although there's a proposal on the table to conform them to the way it's handled for life insurers. At present, a non-bond debt security owned by a property and casualty or health insurance company, it'll be classified as other invested assets, and it'll have an RBC factor of 20%. But that could change and it could conform to the structure that I just described, which will apply to life insurers. Next slide, please. So with respect to CFOs and rated feeder notes, what do we make of them now, given all of these changes? So I think that the most important point to take away is going forward, these structures, they're not automatically going to be bonds or non-bond debt securities. It's going to be important to do a very detailed look through of the structure, evaluating the underlying portfolio of assets to determine whether or not they generate meaningful cash flows and otherwise satisfy the applicable requirements of the ABS definition. So when we think about regularity and certainty of cash flows, a couple things to keep in mind. It's important whether or not the assets generate periodic scheduled payments of principal and interest, bond-like cash flows. With respect to CFOs and rated feeders, the thinking is that if the underlyings are private credit funds or direct lending funds or similar strategies, those will likely throw off bond-like cash flows and therefore qualify for bond treatment. But if the cash flows they vary, or if they are irregular for any reason, it's going to be much harder to get that structure to qualify for bond treatment, and then you'll be kind of in the non-bond debt security world that I was just describing. Next slide, please. Evaluating CFOs and rated feeders in the context of substantive credit enhancement. So what should we be looking for here? Again, going back to fundamentals, the credit enhancement must result from the holder of the CFO or the rated feeder being in a different economic position than if they owned the underlyings directly. That enhancement, it can't be nominal. It cannot lack economic substance. In the case of rated feeders, when we think about sort of the different ways an insurance company can invest in those structures, the NAIC has gotten comfortable with stapled structures where you're taking the entire vertical strip, provided that the tranches are held as separate securities, preferably with separate CUSIPs. In that structure, the debt tranches would be reported on Schedule D, and the subordinated notes would be on Schedule BA. Next slide, please. So at this point, I'm hoping the answer to the title of this slide is self-evident, why it matters, whether a fund is an operating entity versus an ABS issuer, given some of Larry's earlier remarks. If a fund is an ABS issuer, it's going to be much more complicated, the analysis as to whether or not debt issued by those funds gets bond treatment. A couple further points. ABS must satisfy additional tests that ICOs do not. They need to provide substantive credit enhancement, and the underlying collateral needs to consist of, as we've discussed, financial assets or cash generating non-financial assets. So that's the reason why, if we're talking about an unregistered fund, having it structured as an operating entity is incredibly important to avoid those additional criteria. Next slide, please. Okay. The definition of operating entity, which is included in the concept of an ICO, has been carefully crafted to avoid including CFOs and rated feeder notes. There's some history around this. I think when the definition was originally promulgated, it included registered but not unregistered funds. There was pushback from interested parties on the basis that there's no principal distinction between the two. And if we're moving to a principles-based approach, then why would you take that position? The NAIC sort of hesitatingly moved in a direction of allowing both registered and unregistered funds to qualify for ICO treatment, and perhaps created an opening for some overzealous parties to think that CFOs and rated feeder notes could be shoehorned in, which the NAIC, was never their intention. And so there was a reaction to that. So we've arrived at a place now where the definition of operating entity, it does provide a path for various types of finance to operating funds. Those are funds which raise primarily equity capital, and to the extent that they're issuing debt, they're doing so to create levered returns. So we can see things like subscription and NAV financing qualify as ICOs under certain conditions. Next slide, please. At this point in the process, there are a number of resources which are now available. So there is an issue paper that has been adopted by the Statutory Accounting Procedures Working Group, which gives a lot of information, most of which we've covered in the course of this CLE, but there's a link in the slide deck. It's worth clicking on and reading through. There's also a training course that the NAIC has created. Again, it goes over the basics. It's very useful if you're someone who's going to be thinking about these issues on a regular basis. It's certainly worth spending the time to take that training course. Next slide, please. There are also now a number of Q&As, again, accessible at the link in the slide deck, which take on specific scenarios which are not necessarily obvious based on the definitions of ICO or ABS, how they'd be handled. So I invite you to take a look at that as well. Next slide. Here we have an example of an asset class that's going to lose bond status. We've given a couple of these already, so I don't want to spend too much time on this. But if you're somebody who is interested in particularly how single asset, single borrower, commercial mortgage-backed loan securities will qualify on a going forward basis, in short, it's going to matter very. It will be very important whether or not those structures provide for multiple tranches or if they're unitranche. In a unitranche structure, there's no substantive credit enhancement, so that won't qualify for bond treatment on a going forward basis, and it will be a non-bond debt security. Next slide, please. One last point on this, we'll kind of move through it quickly. There are different definitions of ABS in the principles-based bond definition as compared to how it's used by the SEC when licensing NRSROs, and so that did create some confusion. The changes that are referred to, the clarifying edits referred to in this slide that have been recently made by VOSTIF, were just intended to kind of clarify the scope of applicability. The definition of ABS will be used for purposes of determining whether or not something qualifies for bond treatment, and whether or not the provider of a private credit rating on that particular structure is or isn't licensed to rate ABS by the SEC won't bear on the applicability of that rating for RBC purposes.
Thanks, Jared. I'm going to talk a little bit about the increased RBC charge on residual tranches of asset-backed securities. And before I do that, I just want to highlight one aspect of what was mentioned before about what happens if you fail the bond definition and become a non-bond debt security. That's a new animal. Never was something like that before in the NAIC system, a non-bond debt security, but there will be after January 1st. And Jared already highlighted one of the most important features of that, which is that you lose filing exemption, and that it has to be filed with the SVO to receive a designation in order to get a bond-like RBC factor. And right now, also, as he pointed out, only life companies can do that. P&C and health don't have that ability. They'll just get a 20% charge unless and until the Capital Adequacy Task Force decides to put them on the same footing as life companies. But a couple of other things about being a non-bond debt security. You probably heard this term Schedule BA. That's the schedule of the statutory investment schedules that they'll go on instead of Schedule D. And there will be a new subsection of Schedule D for non-bond debt securities, which actually will be broken down based on the reason why it failed the definition. Was it for lack of a creditor relationship? Was it for lack of substantive credit enhancement? Was it for lack of meaningful cash flows? And then being a Schedule BA asset, it will be reported initially at cost and subsequently at the lower of cost or fair value. So that benefit that I talked about at the very beginning about how bonds on Schedule D are carried at amortized cost and are not marked to market as long as they're above an NAIC 6. If it's a non-bond debt security, it's always going to be carried at lower cost or fair value. Next slide, please. Let's talk about these residual tranches. So the background is that the NAIC in 2022 created a new working group to mid to long term review the RBC treatment of asset-backed securities to assess how best to capture the risk. Should it continue to be based on a rating type approach? Should it be modeled the way commercial and residential mortgage-backed securities have been roughly since the great financial crisis, or some other method? And that's their mid to longer term process. The short term is to address the RBC treatment of residual tranches, because there was a belief by the SVO and the Structured Securities Group that in a securitization, the total RBC, if you held the full stack of securitized issuances, would be significantly lower than if you held the underlying obligations directly. And that they consider that to be regulatory arbitrage, and they felt that there should be something done to try to even that out, and that the way to do it was to increase the RBC on the residual tranche. So there was initially a division of opinion between even the members of the regulators who sit on the working group, but also within the insurance industry on whether or not that it was true, whether the 30% equity charge on the first loss tranche was too low and needed a boost, or whether they should wait for that mid to long-term project before making any changes. Next slide, please. Well, where did they come out? They decided first in 2023 that they would add a 15% sensitivity factor for the life RBC for residual interest. Essentially what a sensitivity factor is, my layman's language, is it's like a pro forma addition to show what the RBC would be if you had a 45% instead of 30%. But in 2024, they went all the way, and for this year, the life RBC factor for residual interest has gone up from 30 to 45%. It's called an interim change. It's responding to the view of some regulators and some insurance companies that that 30% was just too low for the risk exposure of a residual tranche. And they did also a parallel increase from 15 to 20% for P&C and health companies. Not that I doubt that P&C and health companies own a lot of residual interest. Going forward, the working group is going to continue working with the American Academy of Actuaries on that longer term solution. Next slide, please. Let's advance to slide 40, please. So what is a residual interest? It's based on substance rather than form. And this definition actually goes back to 2023 and has been effective for a year already. A residual interest exists in a structure that has a discrete pool of collateral assets. The collateral assets generate cash flows, and then excess funds after the contractual cash flows are paid to the debt holders. The holder of the residual interest gets whatever is left over, and that's why it's called residual. So they're absorbing losses before the debt holders who rank senior to them. And that means a residual interest holder may ultimately receive nothing, or may receive less than projected, or they may receive more than projected, based entirely on how the underlying collateral assets perform. Next slide, please. So some common characteristics: residuals often don't have a contractual principal or interest, or they may have stated principal or interest, but with terms that allow them to not get what is that stated principal or interest without triggering a default. So it's not really a contractual principal or interest. They generally don't have credit ratings or NAIC designations. They're providing the subordination. Everything that Jared talked about how you have to have substantive credit enhancement to be a bond. Well, where is the substantive credit enhancement? That's the job of the residual tranche, to absorb those losses before the bonds have to absorb losses. So next slide, please. Oh, before we get to that, I want to also mention, since we're talking residual tranches, that there is one other characteristic, which is that for a residual tranche to be an admitted asset, the tranches above it have to qualify as bonds. So if they're not, then the residual tranche is not an admitted asset. And another point actually that was in the slides but wasn't mentioned before is that a non-bond debt security has to have underlying collateral that would itself be an admitted asset. If it's a bond, it doesn't matter what the collateral is, as long as you satisfy the prongs of the bond definition: substantive credit enhancement and meaningful cash flows. If it's a non-bond debt security, then it does matter what the underlying collateral is. The underlying collateral has to itself be an admitted asset, meaning the insurance company could have invested in it directly. So something like student loans, consumer loans, rail car leases, those aren't admitted assets that an insurance company could have held directly on balance sheet. So if an insurance company wants to get exposure to that asset class, it has to do it through a bond, through a securitization that meets the asset-backed security ABS tests of substantive credit enhancement and meaningful cash flows. If it fails the bond test, it won't even be a non-bond debt security because of the underlying collateral not qualifying as admitted assets. It will become a non-admitted asset. And that's, of course, the most serious consequence of all, because it means that asset is charged against the surplus. It doesn't count toward the surplus of the insurance company. So one more hazard of being a non-bond debt security. It's not the end of the world to be a non-bond debt security, but it does create some more issues. Needing to file with the SVO, needing to market, and needing to have underlying admitted assets in order to even be an admitted asset. Okay, so now let's talk about another one of the major issues that we're talking about today, which will bring us close to the end, which is there is a new process now that allows the NAIC to challenge and potentially override NAIC designations that were derived from the rating agency ratings on filing exempt securities. Next slide, please. Remember, I said that 80% of securities roughly are filing exempt, meaning they automatically get the NAIC designation. It's just done by computer from a data feed from the rating agencies into the NAIC's databases, translating the rating agency rating to an NAIC designation. And then only the remainder that got filed were ones where the SVO actually did the credit assessment. Now there's a possibility that the SVO, even on the 80%, could say we are not comfortable with that rating as the source of our NAIC designation, and we think it should be different. So the background is, I said earlier that since the great financial crisis, the NAIC staff at the SVO and Structured Securities Group have been somewhat interested in reducing reliance on rating agency ratings. In 2021, there was a memo that was addressed to the Voss Task Force that reviewed a sample of privately rated securities where the credit rating providers' rating differed by 3 to 6 notches higher than the staff's own analysis would have assigned. And then also an analysis of securities that were publicly and privately rated, showing differences between multiple rating agencies that rated the same security. So that became the kind of the fuel for the fire for the SVO to say the rating agency rating should not be the last word, maybe the first word, but not the last word. We should be able to have the last word. And next slide, please. The initial proposal from May 2023 was outlined a process where the staff or a state regulator could contest their designation assigned through the filing exemption process if it believed the rating was not a reasonable assessment of risk of the security for regulatory purposes, and where there was at least a 3-notch difference between the rating agency and the SVO assessment. Next slide, please. The problem with the original proposal that people didn't like, and that led it to it being revised over the next 15 months of iterations, was that there needed to be more checks and balances and more due process for insurers to give the insurers a chance to make their case, first to the NAIC staff and ultimately to a neutral decision maker, which has turned out to be a subgroup of the VOS. They did finally adopt it, though, in August 2024. It's going to go into effect in 2026. The delay is in order to allow the NAIC to modify its systems to accommodate the override process. Next slide, please. In conjunction with this, the VOS task force voted to amend the definition of an NAIC designation. And what they're trying to do with that amendment, it's relevant to this override idea because they're distinguishing the concept of investment risk as they see it from credit risk. And how do they distinguish it? They say that investment risk is the likelihood that an insurer will receive full and timely principal and expected interest. And credit risk focuses on the ability of the issuer to fulfill the contractual payments. So an example of where that would differ would be a principal protected security. Jared alluded to that earlier. You've got 100% principal protection, but the return is based, at least in part, on the performance of some non-debt variable, maybe an equity index or basket of securities. And that's not going to be a bond under the new principal-based bond definition because it's deemed to be not a creditor relationship. But the example here is that a rating agency might give a pretty high rating to that because of the principal protection, the contractually promised component, and the ability for that to be repaid, but might not give as much weight to the non-guaranteed portion. Whereas the NAIC is looking at this, the SVO, and saying we care about the overall investment risk, including that part that the credit rating agency might not have been measuring. So now I'm going to hand it back to Jared to step through the detailed steps. And I'm afraid because of time, we may have to go through them pretty quickly, but what does this override process look like? Jared?
Thanks, Larry. Okay, so the adopted process is as follows. In the first place, it can again be initiated by a state insurance regulator or the IAO if they form a belief that an NAIC designation assigned through the filing exempt process is not a reasonable assessment of investment risk of the security for regulatory purposes. Next slide, please. If they do come to form that belief, they'll do an initial review, the purpose of which is really to determine whether or not a full review is required. In the course of doing that initial review, they're going to consider a number of things. They're going to compare how that particular security that's now under review has been rated by different CRPs. They're going to see if the return on the security is consistent with what you would expect of a bond. They're going to deploy their own kind of proprietary methodologies about which we don't have a lot of insight. Larry will talk about that more. And then any other factors that the credit committee of the IAO deems relevant to its review. If the credit committee's opinion is that the NAIC designation assigned through the filing exempt process after reviewing all of those sources of information that I've just described is not a reasonable assessment of its investment risk, then the security will be placed under review. It'll be denoted with a UR symbol in its statutory statements. And a full review will be commenced. Next slide, please. So that full review begins with an information request. So the IAO will then solicit certain information from an insurance company relating to the security. The insurers must respond within 45 days. They can request up to an extension of another 45 days, but this is really important. If that information isn't forthcoming by that outside date, 90 days from the date of the request, then the security is going to be removed from it will no longer be filing exempt. So, potentially strict timing requirements and a potentially draconian consequence if there's a failure to meet those timing requirements. Next slide, please. So insurers can participate in this process at various points. At this point in the process, they can submit their own information. That can be their own kind of internal analysis of the security. It could be presentations that have been provided by the issuer of the security. They're encouraged to provide this information that the IAO will then take into its review. The IAO will provide the insurers with a written summary of its analysis as to why it believes the credit rating provider's risk assessment is unreasonable. And then there can be some back and forth that ensues. Insurers have the opportunity to ask questions about that analysis, and the IAO will respond to those questions. Insurers can also invite other parties, including the credit rating providers themselves, provided that they agree to certain confidentiality requirements needed to participate in discussions with the IAO. Next slide, please. Okay, so the IAO has its own sources of information and sort of conceptual frameworks through which it'll be evaluating the security. It will have engaged with the insurers at this stage of the process, received information from them, perhaps had kind of back and forth with them. And they're arriving at their own view as to whether or not the rating is appropriate. It's a reasonable assessment. In doing so, they're going to be applying a materiality threshold. So if upon completion of its analysis, the credit committee will determine its own opinion of the NAIC designation category, it can proceed with the process if the committee determines that I apologize. Let me just back up because I think I missed a step here. So upon completion of the IAO's analysis, the IAO credit committee will convene to determine its own opinion of the NAIC designation category. The IAO can proceed with the process only if the credit committee determines, based on its review, that the IAO's assessment is a 3 or more notch difference from the NAIC designation category determined by the eligible CRP credit rating. A 3-notch difference is material based on the chart that Larry showed at the top of the hour. It approximates a doubling of the relevant RBC factor. So that is a very significant difference. Next slide, please. Okay, so if that materiality threshold is met,
I think a slide was skipped. I think the slide was skipped, right?
Oh, did we go
Okay.
from?
Go ahead. This is right.
Yeah. Okay, great. So if that materiality threshold is met, then there's going to be a call that's scheduled with a subgroup of the VOS task force at which both the IAO and the affected insurers can appear. The IAO is going to have to submit its position in writing and supporting rationale in advance of that meeting for review by the subgroup of the VOS task force. The domestic regulator of the affected insurers can participate in that meeting. And insurers can, again, they can invite other authorized parties, including those credit rating providers, subject to the confidentiality requirement. After that call, the VOS task force subgroup will decide whether or not it agrees with the credit committee's opinion that, in fact, the rating is not a reasonable assessment of risk. Next slide, please. If the subgroup of the VOS task force agrees with the credit committee's opinion, the security will be removed from filing exemption. It will no longer be filing exempt. and the IAO's determination of the NAIC designation category will be entered into the NAIC systems with an analytical symbol of ER. But, and this is an important caveat, if that same security has a different credit rating from another eligible NAIC CRP provider, it can receive the NAIC designation category through the filing exempt process based on those NAIC CRP ratings that have not been removed. Okay. An insurer can ask the IAO to reevaluate an eligible NAIC CRP rating that was removed previously in a subsequent filing year. Next slide, please. So the decisions that come out of this process, they will be made public. Within 45 days of security being removed from filing exemption, the IAO will publish an anonymized summary of each unique situation on an insurer accessible website. The anonymized summary will not include references to specific securities or credit rating providers or impacted insurers. The IAO will also publish an annual anonymized survey of actions taken in the prior year. So there are a number of process enhancements which I think do go to the underlying concern around due process, but notwithstanding those, stakeholders have raised other concerns, which Larry will discuss now.
So how often will the process be used? You've probably all read it by now. I don't need to read it to you, but there's been a lot of indication from the VOS task force that it's intended to be used sparingly and to be used consistently to all credit rating providers and not expected to be used often. Next slide, please. Are you still hearing me okay? Nod, Jared, if you can. Yes, okay. There have been concerns that the IAO is not required to use any published methodology in the way that rating agencies are required to do. And that's the case. The SVO is entitled to use whatever methodology or methodologies that it believes will produce a reasonable assessment of investment risk for regulatory purposes. Next slide. There are concerns regarding the relationship between the SVO and rating agencies. Some have suggested that the SVO is trying to compete with or replace the rating agencies. The position of the VOS task force on that is that the SVO is not trying to be a rating agency. It is not a rating agency, it's a consumer of rating agency ratings, and it wants to be able to use the rating agency ratings responsibly. So they're not overruling a rating. In their view, they're choosing not to use a particular rating for regulatory purposes. And that distinction I mentioned above between credit risk and investment risk is maybe part of that distinction. Next slide, please. The one-way timeframes, that the insurance company has limited timeframes to respond to the NAIC staff information requests, but the NAIC staff doesn't have timeframe deadlines on its side. And the answer to that was that the staff would do their work expeditiously once the required information is provided. Next slide, please. The role of the credit rating providers. This was one that went right down to the wire. There was a credit rating provider that urged that they should be informed at the outset of the process, just like the insurance company is, and they should be receiving all materials, and they should be able to participate in the review and in the hearing, whether or not the insurance company invited them. And the E-committee, that went up to the E-committee, the parent committee, which declined to make that change. And the reason they gave is that these processes are under the rubric, the umbrella of insurance department's regulatory examination authority, which is by statute a confidential process, and that only the insurance company could waive that confidentiality and invite a credit rating provider to participate. So likely that they will, but they're not required to, and only if they do does the credit rating provider get into the process. Next slide, please. Jared, I suggest, given the time, that we might want to skip over PPS, which you already talked a little bit about.
Yep. Yeah, given time constraints, I'll just say a couple very brief things. One is there is a definition of principal protected security. It is a very complicated definition, and so We're not going to have time to unpack it now, unfortunately, but I will say that care must be given when you are evaluating whether something is a bond, that it doesn't inadvertently fall into the definition of a PPS. That's a really important point. Happy to discuss in more detail offline. Skipping ahead just to the CLO modeling effort. Just one quick point on this. There is an effort underway to treat CLOs as financial modeled security, which is how CMBS and RMBS are currently handled. That process is ongoing and work is being done with the American Actuarial Society. But we don't have a structure yet. It's continuing to be evaluated. Again, just these are very high level remarks, so of course we're happy to talk in more detail. Both my and Larry's contact information is on the front page of the deck. We didn't have a chance to address any questions, unfortunately, but we're happy to do so. Please don't hesitate to reach out to us.